2026 is halfway over, and believe it or not, if you made equal investments in all of the Magnificent Seven stocks, you're actually losing money so far this year. And that's not because of a poor stock market. The stock market's actually up. I ranked all 7 of the Magnificent Seven stocks from most likely to crash to the safest. Watch the bar at the bottom fill up as we go along. Every stock gets 4 quick reads: the moat, the optionality, the valuation, and whatever the biggest risk is. Green is strong or cheap. Yellow is caution. Red is danger. The colors are going to do the talking here. All right, so we're going to count up, starting with the one that's the riskiest, the most likely to crash, and end on the safest of the bunch. However, it's really important to point out that the most likely to crash is usually also the one that's most likely to be a significant outperformer, because risk goes both ways. Number 1, most likely to crash or be an outperformer is Tesla. It sits all alone here on the far left. Every other name is bunched way over on the safer side, and that gap is the whole story with this first stock. Now, if we think about Tesla's moat, in its traditional business, it's somewhat shrinking. Now, it's true that the EV market in general is having a weak period, but some of those cost advantages just aren't playing out for Tesla. The reason that it is still as highly valued as it is because of the second one, optionality. We're talking full self-driving, robo-taxi, energy and storage, Optimus. But the valuation is stretched, and the biggest risk across all of this is simply execution, actually pulling off profitable full self-driving, robo-taxi, energy, Optimus, and all the different things and regulations that play a role in there. I mean, look, even if we grant this company a 15% free cash flow margin, which is pretty generous given its legacy business, revenue still needs to grow by 25% or more per year for 10 years to justify the stock price. And that combination is why Tesla finds itself alone on the left-hand side of the market. Now, the next company we're going to talk about, what I want to point out is all the rest of these, for the sake of the visual on the bottom, they might not look all the way over here on the right, but most of them are much further to the right. The next safest that I'm going to call out is Apple. Huge gap from Tesla. It jumps right into what I would call the much safer cluster. Look, the moat here is super clear. People have their iPhones, their iMacs, their iPads, their iTunes, their iCloud. They're all connected. They're not leaving this ecosystem. But I would say that some of the optionality is limited, at least when we think about it in terms of needle moving optionality. They've done a great job with the watch, with their services, but I'm not sure where needle moving optionality is going to come from in the future. I think that the valuation is stretched at today's valuation, especially when you consider that the opportunity to increase those free cash flow margins, I'm not quite sure where that's going to come from. I don't think that this is a stock that's going to crash. It just might not be a super significant outperformer moving forward. And the biggest risk is just growth. They need to show we've had single-digit growth many times over the last couple of years, and that is, in essence, the biggest risk. Now, if you like analysis like this, I want to let you know about my program, Stock Investing Mentor. Stock Investing Mentor comes in 3 parts. The first part is you get full real-time access to my portfolio. The second part is ongoing coverage of what I call the antifragile stock universe, where all the stocks have an anti-fragile score, a valuation score, and a combined total score. And every month I update with the top 5 stocks that I would buy if I was starting a portfolio from scratch today. And finally, 1 hour of live weekly training and 24/7 access to a private online investing community. If you'd like to join Stock Investing Mentor, top link in the show notes below will get you 10% off an annual subscription. All right, so we talked about Apple. The next in this is Nvidia. It lands a notch safer than Apple. And here's my take. After its recent pullback, I think it's cheaper than it looks. Because look, it took a long time for me to be convinced that CUDA represented a meaningful moat. And I am convinced now it does. And once these data centers start being built using Nvidia and with engineers using CUDA to put these pieces in, it's going to be a lot to rip them out, not to mention the first mover and head start that it has in IP. The optionality is huge. AI is everywhere, and the company has already talked about their next generation Rubin and moving into CPUs. I think it's actually relatively cheap at today's numbers. If you give Nvidia a 35% optimized free cash flow margin, which is significantly lower than it is today, and you assume that it meets its growth targets over the next 3 years, then after that, the company needs to grow at an average about 17% per year. Now, this is a cyclical industry, and so we don't know what's going to happen. We also don't know if the next 3 years' growth targets are actually underestimated. And if they are, then the growth doesn't even need to be near as high. But here's the thing. The reason that Nvidia lands where it does to the left of the next couple of Mag 7 stocks is because you have to remember that this is a historically cyclical industry, and we've got to account for that. And if the cycle turns, it can hurt a lot of the players in this industry, Nvidia chief amongst them. Now, coming in next in the truly boring safe zone is Microsoft. It's kind of been the default winner of every tech trend that we've had over the last 20 years. I think that the moat is very wide, from Azure to Copilot to 365. I think that the optionality is fair. It seemed for a while that this was the company that was on the cutting edge of AI. It doesn't so much seem that way anymore. I do still think, given the build out and the network that they have, that they can add additional optionality in there. I think that the valuation is relatively fair valued right now. And I think that the biggest risk just has to come with what happens with CapEx. And this is kind of a double-edged sword, because if Microsoft says that they're pulling back on their CapEx spending in 2027, well, then people might think that the AI trade isn't working out. That could hurt them. It could also help them because investors want to see those profits, and a pullback or at least a plateauing in CapEx spending could be a signal that profits are coming down the road. Now we're getting to our top three of the Mag 7. Really, these could be interchangeable, but the next one that I have is Google. It's sliding in, and it's even safer than Microsoft. Look, the moat is clearly there in search, and I think that the optionality is pretty deep. For a long time, they had their other bets, and none of them were ever really hitting. But now Google Cloud is clearly some optionality that the company has. They've shown how YouTube can be folded in, although it's really still just part of the legacy advertising business. But the two big ones could be Gemini and Waymo. Those could be needle-moving optionalities moving forward. I think that the valuation is fair at today's prices, given that it's tough to know exactly what free cash flow margins could look like in the future. We know that they're depressed right now because the company is spending on its AI data center build out. The real threat that I would say here is the one that kind of has been dogging it for a while, which is that could AI take away the search and advertising dominance? Their ability to use Gemini and create tools that actually gather just as much data has proven a lot of those naysayers, myself included, wrong, but it is still something to keep your eye on. And now we're down to the top two. Coming in at number 2, I've got Amazon as the second safest. Because look, it's got two engines in one stock. It's got AWS, and it's got the retail plus fulfillment plus ads machine. That moat is super wide for both AWS and the e-commerce. The e-commerce has network effects. It's got some switching costs in Prime. The big switching costs are in AWS, but it's also got low-cost production, where low-cost production from a lower internal cost of getting packages to your front door, nobody else can even match that. The optionality here is broad. They've got advertising. They've got fulfillment by Amazon. They've got Project Leo. They've got a potential move into healthcare. And look, it will always look pricey on an earnings basis because they plow so much back into the business. But I like looking at price to trailing operating cash flow. I think that the company is fair to slightly undervalued at today's prices. It's just 16, 17 times trailing operating cash flow, and usually it's at that 20% or higher, but I think it's still very safe. The biggest thing that you've got to keep your eye on is margins, and it's margins over the long term, because when the company reinvests in itself, those margins get cramped. What you want to make sure is that those margins are cramped because of reinvestment, not because they're losing pricing power, which means that coming in at number 1 on a day when they announced they're entering potentially the cloud computing industry is Meta, the furthest right on the board for me. Look, The moat in the traditional business is a combination of the network effect, because if you join Facebook or Instagram or WhatsApp, it makes it more valuable to me. And it's one of the largest network effects with billions and billions of users all over the world. But it's also a low cost production. Why? Because nominally, it doesn't cost Facebook that much to collect gobs of data that it can then use to sell to advertisers. Now, I think the optionality is strong, and today is kind of part of a proof in the pudding for that. The reason that I say that is because a lot of people were worried about these investments in AI that Zuckerberg was doing without having a cloud business. The fact of the matter is, one, it's true that this has improved the engagement on Meta's different platforms, but two, we saw in the past when they burned a whole bunch of money on the metaverse, they could call it quits and rely on that cash generating machine of advertising to push them forward. But in this case, they can sell their extra capacity, and that is what we are seeing today. That was the reason that I personally bought shares, because I believe the market underappreciated the capability to pivot like that should they choose to do it. I think the valuation is fair, if slightly, I actually think it's slightly cheap at today's prices. It is going up a bunch. The biggest risk is that spend, if the company decides to keep spending on AI assistance, and they don't see return on those investments, that could be a risk. So there you have it. That's the whole board. 6 of them bunched over on the safe side. Tesla out there alone. 1 outlier, 6 safe. That's the call. What do you think? Let me know in the comment section below. And until next time, Brian